We're entering the biggest financial reset in history, one that could send Bitcoin to $1 million and shake Wall Street to its core.
Most people, the majority of people don't get Bitcoin, don't understand Bitcoin because they don't see the problem.
That's why I sat down with Mark Moss. He rebuilt from losing everything in 2008 to becoming one of the most respected voices on Bitcoin and macro today. He's a best-selling author, read by millions. He co-runs the Bitcoin Opportunity Fund, channeling institutional capital into the Bitcoin ecosystem, and serves as chief Bitcoin strategist at Satsuma UK, where he helped lead the largest Bitcoin-linked capital raise in UK history, over $200 million, including more than 1,000 BTC subscribed directly into the deal. When Mark speaks, serious money listens.
Heck yeah, you should. Heck yeah, you should be worried. Everybody should be worried by that. And the reason why is because you will certainly lose. You won't win.
Because while most people are still chasing passive income and old playbooks, Mark reveals where real wealth is moving next.
Every single company in the world will be a Bitcoin company at some point.
And then he ties it all together. The cycles, the liquidity, the adoption into one bold price target for Bitcoin's future.
By 2030, that'd put it at $21 trillion or $1 million per Bitcoin.
Mark lays out his blueprint for how global liquidity, corporate treasuries, and even sovereign nations are about to lock up Bitcoin, and why understanding this shift could be the difference between being left behind or changing your life. And guys, make sure that you give him a follow both on YouTube and X. I'll leave the link in the description below. Without further ado, let's welcome the man to the stage, Mark Moss. Correct me if I'm wrong, but I think that you were an entrepreneur that I believe lost everything in 2008.
I built an internet business in 2001, so sort of coming out of that, crushed that. I had a real estate business, had a high-tech medical equipment business, had a big Fortune 500 exit with that. And by the time I was 28 years old, I was retired, had the big house on the hill with the ocean views and the elevator, and I got married, I had the kid, the whole thing, and then 2008 came. And the thing with that was, yeah, I got crushed. Right, absolutely crushed, because what happened is I sold all my businesses, which produced revenue, income, and I put it all into passive assets. I put it all into real estate, and in California, real estate dropped 60% in a year. And so, yeah, I got blindsided by that. And the problem for me was at that point is that I was really good at making money. I could spin up different businesses in different niches. I could make a lot of money with that, but I wasn't paying any attention to the global financial system. Mm-hmm. And that's what caused the pain, right? That's what I got blindsided by. And I was just like, what happened, right? Like, man, I understand the business side, I understand the wealth creation side really well, but like this global financial system has all this power over my life and I'm not even paying attention to that. So like, let me try this again. Let me figure that out. And so that's what sort of radicalized me and got me to where I'm at today. And so I had to go figure out what the global financial system. I very quickly realized that, well, it was the bank collapse. The bank collapsed because of over leverage. Okay, so over leverage because of the financial system. Okay, the problem is this fiat currency. The problem is this debt-based monetary system. So that's the problem. Okay, so gold, it seems like the solution. So I became like a gold bug. And so I think that's a really key piece to understand, though, is like I had to go figure out what the problem was. And as I understood the financial system, I understood the problems in the financial system. And so then once you understand the problem, can you then go find a solution for that? And I think most people, the majority of people don't get Bitcoin, don't understand Bitcoin because they don't see the problem. So anyway, I saw the problem. The solution was we need sound money. I became a gold bug. And then as I discovered Bitcoin later, I realized I'm not a gold bug, I'm a sound money advocate.
Yeah. Interesting that your story about real estate, because I think a lot of people think that that's the right thing to do.
Yeah.
Right? It's a lot of people's goal and ambition is just, let me have a career, start a company, whatever, I'll buy, a bunch of houses and then live off of passive income. Mm-hmm. But you haven't seen that here in Austin right now. It's a big correction in the pricing and the prices. I don't know if it's going to continue to keep going down or not, but it certainly is not keeping up with the pace of Bitcoin or even gold or anything like that.
Yeah. I mean, a couple of things I'd say about that though, real quickly, is like, number one, real estate has been a great way to build wealth for a lot of people.
A lot of people, yeah.
Bitcoin is, real estate is like elementary. Like anybody can get it. It's very simple. It's very easy, right? I buy a house, I rent it out, I deduct the payment. And so it's like, it's as far as like investing goes, like I'm not trying to figure out NVIDIA's new microchip and how many GPUs will be in demand for the hyperinflation AI boom. That like, you know what I mean? It's just like real estate. So, it works for some people. Certainly the return on real estate will never beat the return on Bitcoin on a pure standard. But I think Bitcoin, real estate is also misunderstood in a sense where there's a lot of other things that real estate has that Bitcoin doesn't have. So for example, in America, I can get 30-year fixed loans. Cheap money that inflation is going to pay off for me. That's pretty good. Number two, especially thanks to Trump's new one big beautiful bill that just got passed, we have this massive depreciation I get from the house so I can write off my income and not pay taxes. That's pretty good. I can have a tenant that makes the payment and pays the house off for me. Like, that's pretty good, right? So there are other advantages. And I think it depends on how much money you have. But as you get more money, as you get more wealth, you have to have different strategies. And I think there's different tools for different pieces. But certainly I would agree with you 100%. Like Bitcoin is way more exciting, way more revolutionary, and it's going to build wealth way faster.
So you had the 2008 awakening, and then you had to go figure out what the hell was going on.
Yeah.
Right? Because you got screwed essentially.
Yeah.
So what did you learn other than you told me you're looking for sound money. Okay, cool. But what was like the biggest kind of aha moments from that whole experience?
Yeah. Well, there's a couple lessons that I would say that we learned, right, or aha moments. So I think number one, like what got me into the trouble in the first place. So you mentioned kind of real estate and like passive income. So I think most people are on this like pre-programmed track in life where like, well, go to school, get good grades, save for 30, 40 years, and then I could retire one day. A lot of people think that, well, maybe the way out of that game, out of the rat race is I need passive income, right? And so I was also in that trap. So I had multiple businesses that I sold. And I had like my medical business. It was a high-tech medical equipment company, digital x-rays and cameras and things like that. And I sold it to the largest company in medical, Henry Schein, multi-billion-dollar company. But this business, I built it. I'd been in the industry for a long time. I knew the ins and outs of the industry. I knew all the people in the industry. I knew all the players. The business kind of ran by itself. I had a good team. It made a lot of money. I mean, so much that a big company wanted to buy it. But I thought I'm supposed to sell that and go get passive income, right? That's the way out of the rat race, right? You sell your business and you go get passive income. So we have these pre-programmed tracks. We don't really think about what that means. So I did. So I sold the business, a business that, again, I knew at the back of my hand. So my risk level in that business was low. My risk level, because I knew everything about it. I knew the ins and outs. I knew the business, the players, right? And then I took that money and I went to go buy passive income and a bunch of real estate that I didn't know anything about. Instead of it became a massive nightmare. I'm flying back and forth the country all the time. Now I'm fighting with partners. Now I'm losing money. Now I created all this risk, the opposite of passive or work. I created all this risk and I lost a bunch of money because I thought I was supposed to sell the business to get the passive income. So that's one big lesson that I learned. And ultimately the takeaway from that, and I think the key takeaway for everybody listening is that there is no such thing as passive income. That's false. There's a spectrum of work that's required for the income. So even if I wanted to buy a dividend stock, IBM, that's pretty passive. I can't go work at IBM, obviously, but how much work does it take me to look at the stock market and evaluate which ones I want and which company is going to be the best and buy IBM? There's work. And then I have to watch the market on a pretty regular basis. Is the value of the stock going to go down? And should I be buying more or selling more? So there's a little bit of work, but it's a little bit of work. But my return is only 3.5% or whatever, right? Mm-hmm. I can buy real estate for passive income. I can make more. Now I can make 8 or 10%. But now I got to deal with tenants and property management issues. So it's a spectrum of work and income. Passive, as in zero work, is a scam. Now, in my business, that was essentially passive income because I had a whole team running that. So I can create, so what I do is if I understand that it's a spectrum of work the answer isn't how do I get the work down to zero? The answer is how do I build systems to allow that to run on its own so that I can have less input. So in my business, I can create systems and hire the right people so that business basically runs by itself and is passive, but yet my return is high. So that's one lesson I learned. And so it's changed my entire outlook of how I build businesses and think about passive income. The other thing that I learned is that the problem that I made, which in hindsight is kind of ridiculous, but I had sold all my businesses. So that meant I sold all my income. So I had no income anymore. Now I had a lot of money, a lot of zeros in my bank account, and I put a lot of it into real estate. But when the market dropped, 60%, now I have, $185,000 a month of debt service to cover. And there's no income coming in. And like, how long can you cover 185 grand a month with no income coming in? And so that was problem number two. And so obviously that didn't work out super well. So number two is that we don't get rich from investing. We get rich by creating value, by building wealth, and then multiplying the wealth through investing. And so we always need to be making money, and then we need to be multiplying our money. Yeah. And I see way too many people, I'm sure you do as well, who want to come into this market and they want to quit their job and they want to be a full-time investor and get rich investing. And it's like, it doesn't work that way. And I don't know why people get that. I don't even know where people get that from, because you look at maybe the most famous or successful investors in the world, like Warren Buffett or Ray Dalio, right? Big names that everybody would know. And Warren Buffett went to work at a company every day. He just retired right this year at 93, and his business is called Berkshire Hathaway. And that business is a conglomerate that buys other businesses. Like, that's work. It's not an investor, right? Ray Dalio went to work every day at a company in a building called Bridgewater Capital, right? Like, and so like, I'm not sure where people get that, but I think that's another lesson that I learned is like, no. We always need to be building wealth through businesses by creating value, and then we multiply the wealth. And so I would say in hindsight, and then in regards to real estate, which is basically the same thing, but in regards to real estate, because I still own real estate, I own this ranch here that we're in right now. The other lesson is that my real estate that I owned at the time could not cash flow, and I didn't have the cash flow for it. And so then moving forward, it's like, I'll never buy another place if I can't rent it out for the cash flow. But I'd say those are probably the two biggest lessons that I learned. And then I guess I already said, but number three is like, pay attention to the global financial system.
I got into Bitcoin in 2012.
Yeah.
And it was very cheap back then. I had a lot of them. One of the things I wish I had known back then was, like, this is a very valuable asset, so I should probably go get another job or something to spend that money,
right,
versus spending my Bitcoin to survive. I didn't do it just like stupidly and haphazardly, but I was also an entrepreneur and also used my Bitcoin, highs and lows. I didn't really pay attention to market cycles or global macroeconomics or what cycles were. I just spent my Bitcoin to try to fund my businesses,
Yeah.
And I mean, like, I guess, like, I'm fortunate enough that I had enough to start with that I still have some left. I would have loved to have kept all of that I had initially.
That's all our story.
Yeah, and I try to sit back sometimes and reflect, like, would I have been better off just like living very frugally, doing almost nothing, and keeping my Bitcoin? Would have been great off today. Probably even had more money than I have today.
Yeah.
Or had I gone through all the battle wounds and the scars and things that I did, the investments I made, I spent Bitcoin to buy other things like Coinbase and Kraken, which those are good investments, but they're not as good as if I just held Bitcoin. So yeah, it was a big lesson of, I think, that passive income, generating income somewhere else is really important.
Yeah.
Let's get into the current state of the market. I saw recently you posted something about price cycle top maybe pushing out until 2027.
Yeah.
Right, which is, my audience knows, it has been one of the most accurate indicators of cycle tops in history. So do you think that this 4-year cycle is done?
So I think the way that I think about the 4-year cycle is that, one, until proven otherwise, it's on, number one.
Yeah.
But what I'd say bigger than that is, it's not just the Bitcoin 4-year halving cycle. I think Bitcoin is getting wagged by the dog, which is the 4-year global liquidity cycle. So what a lot of people don't realize and think through is that it's global liquidity, meaning the amount of money sloshing around the system that moves asset prices. So when the money supply goes up asset prices go up. When the money supply goes down, asset prices go down. And that's basically debt. We're in a debt-based monetary system. Money is created through debt issuance. So we look at the amount of money, but we can also look at the amount of available credit, because as there's a lot of credit, then there's more money. And so what happens is we have all this debt, and this debt is anywhere from months up to like 30 years, like Treasuries. So you have all these different durations of debt. And all around the world, you have all types of debt with all types of durations. But if your bank called you up and said, hey, we'll refinance you down to 0.5% of interest, you're going to do that. Yep. And so what happened in 2008, when the great financial crash happened, the global financial crash happened, the entire world brought interest rates down to zero. And when the whole world went to zero, everybody refinanced their debt. Mm-hmm. And you took all this debt with all this different duration that all got synced up in 2008. And today, if you look at the total debt, 75% of it has between a 3 to 5 year duration. So call it 4. Mm-hmm. 75% of the debt. Now that was 2008, which then is 2012 and 2016 and 2020 and 2024, which just so happens to also be the 4-year Bitcoin halving cycle, which also just so happens to be the 4-year presidential election cycle, which just so happens to also be like the 4-year business cycle. And so all of these cycles sort of converge. And so the Bitcoin cycle is there, but I think it's a piece of the global picture of what's going on. So then to answer that question, I would say, well, is the 4-year global macro cycle still in play? And as of right now, it is. Anybody could just go into their trading view and pull up global M2, or you could just Google that and find that. I think the GOATs, the GOAT is probably Michael Howell, Capital Wars. He creates a global liquidity scale. My friends over at the Bitcoin Layer, Nick Badia, they have one that's really good. Raoul Paul over at Real Vision has a really good one, if you want to get a little bit more details on that. But I would say we're looking at that. And so let's, if we're thinking about when would this cycle end, if we just look at it from a time duration standpoint, it looks like it should be around Q4 of this year. Mm-hmm. I remember back in 2021, most people, you had Michael Saylor on TV saying that all your models are broken. This time is different. The institutions are buying. And, Bitcoin was in its 60,000 range at the time. And we're like, there's no way this is the top. Like, it's got to be higher this cycle. Yeah. This is not right. Maybe it's not going to peak. It's not going to peak in November like we think it is. But it did. Right on cue. Now, obviously, the cycles and the duration didn't know that Jerome Powell was going to go on the news and announce in November that they were going to start raising rates. But he did. Right on cue, on November, the Fed went on to announce the beginning of the fastest, most aggressive rate hiking cycle we've seen in history, which then, of course, caused Bitcoin to go back down, right? So it was the liquidity cycle that caused the price of Bitcoin to go down, but the peak of the cycle just so happened to coincide with that as well. So the way that I look at this is that we can't predict out if the top will be in 6 months, if it'll be in 12 months, if it gets pushed out to the Pi cycle top being 2027. Because what those are signposts. Those don't give us the time frame. Here's an example of this. So if I gave you directions to come to my house, but I didn't tell you that it was 5 minutes or 5-hour drive. I didn't tell you that. I just said, go down the interstate until you see this billboard and go left. And then drive down the road until you see this red barn and go right. And then drive down the fence line until it ends. But I never told you if it's 5 minutes or 5 hours, right? But let's say there was like 10 turns that you had written down. As you're driving to my house and you're going through each of the signposts, as you click off the 6th one and the 7th one and the 8th one, you're getting closer. But you still don't know if it's 1 hour or 3 hours away. And that's the way that I look at these indicators, right? So we can look at a bunch of on-chain data, which is really helpful with Bitcoin. We can see all this on-chain data to start to understand if things are getting overheated, if they're expensive or cheap. We can start to look at global liquidity cycles. The Pi cycle uses moving averages and when the moving averages will cross. But moving averages are moving.
Exactly, yeah.
Right? And so as of today, it looks like they would peak in 2027. But if Bitcoin goes on a serious bull run in the next month or two, it's going to change the trajectory of the moving averages. Yeah. So rather than trying to go, well, it's going to be in November or it's going to be in Q2 of next year, we just watch the signs.
Yeah.
And so the signs that I'm watching are mainly global liquidity. We understand that global liquidity has about an 8 to 12 week lag to the movements. So back to Jerome Powell going on and telling the market that he was going to raise rates, right? We saw Bitcoin sell off first and then NASDAQ and then S&P 500, but that takes a while. We can see here in 2025, in Q4 of 2024, global liquidity was drying up, even though asset prices were still making new all-time highs at the end of last year. But then in the first quarter of 2025, asset prices plunged because liquidity dried up the previous quarter, even though liquidity was going up. But then we could tell that Q2 of 2025 was going to go good, which it has. We can see that right now, global liquidity is still going up, so we expect next quarter to also go good. So I would say, rather than trying to guess will it be 2027 or 2026, we watch the signs like we watch global liquidity. We certainly watch cycles like the Pi cycle top is really good. I think there's a lot of really good on-chain data. So one is like a MVRV, market value to realized value. We can look at that. And when we look at those charts, we're nowhere near the peak right now.
So are you trying to not care about these kind of fundamental things that we're seeing? Because you could make the argument, but there's nothing to sustain it. Big beautiful bill, $5 trillion increase in debt ceiling. We're in a fundamentally different interest rate environment than we were discussed before. We have highest rates that we've seen in a very long time right now, and we're all thinking that those are probably going to come down over the next 12 months or something like that.
Yeah.
They need to come down at some point. And so this is kind of a different environment where you have already Congress approved this massive increase in spending, right? Which is going to pump global liquidity probably for the next 4 years, something like that. And we're also in this environment where we're likely to see rates start to come down at the end of this 4-year cycle. So I guess, is this still kind of the same discussion? That's a goalpost thing. We're like, hey, that sounds great and it could push things out, but I'm still just going to kind of trust these indicators.
So that's a great question. So I already said that we shouldn't try to guess. We look at the data, but let's try and guess. It's fun. So let's try and do it anyway. So a couple things I'd say. So number one, I would say it does look like the global liquidity cycle is getting pushed out. Michael Howell said he thinks it gets pushed out till maybe Q2 of next year. And some of the reasons why we see this happening is because a lot of these that you mentioned. So number one, we had this tariff shock that happened this year, and that disrupted things, right? And now it's getting going again. But now the seeds of that we're seeing planted. So like number one, we have $8 trillion of commits to start investing into the US. That's a lot of money. Number two, we have Trump. You mentioned, rates, but Trump has been very aggressively trying to get Powell to either budge and lower rates or out or neutered, potentially electing a shadow chair that could usurp what he does. But he's out either way, in the next 6 months. We know that just a couple days ago, at the time of this recording, Ursula von der Leyen from the EU came to the White House and just got schooled like a little girl by Trump. And basically the EU caved to every single tariff demand that Trump had, including investing, I believe it was $900 billion into the United States and for military. Where does that money come from? Oh, they print it, right? We can look at China right now is injecting more liquidity in their system. Over the last 6 months, it's almost like a parabolic turn up. And so we can see all of these things happening. So it does look like global liquidity will start accelerating through the end of this quarter and could easily go into 2026. Understanding what Trump is trying to do, if he can get rate in 6 months, get rates from whatever 5, down to 1.5, which is where I think he wants them to go. That's going to ignite a whole nother boom. And so there's a lot of reasons why I think we could see global liquidity continue to at least hold, if not start to accelerate. There's a lot of reasons why we could do that. The reason why that may not work out is because of the 4-year cycle and what it is. So what does that mean? So for people to understand really what the 4-year cycle is that we're in a debt-based monetary system. The debt never really gets paid or what we call extinguished it gets rolled over, okay? Because in a debt-based monetary system, it always has to grow. We can't shrink the system. So what happens, the reason why we have the 4-year cycles is because, remember, the debt is about 75% of it is 3 to 5 years, not exactly to the day 4. So what happens is on year 3, some of the debt starts coming due and it starts getting rolled and rolled and rolled, but we start running out of available liquidity for that. And that's what causes things to start coming back down until the next batch is kicked in to get us back off to the races again. And so there's a lot of reasons why we could expect liquidity to grow, as we've already covered, but we also know that there's going to be a lot of demand for that. So we'll see how things shake out. But if we're guessing, I think we can see that it easily gets into next year. If Jerome Powell gets replaced with maybe it looks like maybe Pulte from the FHA, he's a real estate guy, he's going to want rates low. We get him replaced with somebody very dovish, the rates drop. Yeah, it could change that trajectory, which is why, again, I urge people to look at the data, not try to guess it. But potentially we could get that to keep going through next year, maybe the rest of Trump's term, possibly. We do also have to understand that the world matters, not just the US. So as I said, right, China has been massively adding liquidity, Japan as well, but the ECB and the US haven't. But as I just said, with the ECB agreeing to the tariff concessions, they're going to have to start easing, and the US is going to start easing. So then we have the 4 major central banks that we care about in the world, all easing, and that could change it. And then in regards to Bitcoin specifically, we've seen a major makeup shift in the owners of the holders of Bitcoin. And so right now we're seeing like Bitcoin treasury companies, public companies, and even governments are buying 10 times more Bitcoin than is what is being produced through Bitcoin mining. So the demand is way outstripping the supply. Where is this supply coming from? Well, a lot of retail is selling. So it's going from individual retail hands, and it makes me sad, but it's going from weak retail individual hands and going to the corporate, institutional, and sovereign hands. And the thing is, like with Michael Saylor, is he's like, we're never selling. Like, we're just not selling. And a lot of the corporations are doing that, and the sovereigns will do the same. And so I think what's also interesting is seeing that go from retail hands to now institutional cold storage, that could also change that 4-year cycle trajectory as well.
I don't. If you're just looking at the Bitcoin kind of cycle, and I think you made a good point that it's the 4-year kind of global macro cycle that Bitcoin's falling under too. But that actually makes more sense, because what I was going to say is that, in the past, we've only had the reminder. People think that the 4-year cycle is stimulated by the halving. It doesn't seem like it actually is, because the halving has always just been an event that happened, but we never had a supply shock before until now.
Right.
And now we have a real supply shock. And people thought that the ETFs were going to be the biggest driver of it, and they have been till now, except for now. Right. And so now we see this new, I call them this Wall Street altcoin season, which is happening, right? Which is the corporate treasuries for Bitcoin, Ethereum, Solana, Sui, Hype, all these kind of coins. What are your thoughts on these crypto treasury companies?
I think what's going on in the Bitcoin treasury space specifically is going to catch most people off guard. I think most people don't realize exactly what's going on, and we'll mainly talk about strategy in this, because strategy is leading the way. They changed the name from MicroStrategy to Strategy so that other people can follow the strategy. One of the natures of this type of a business, a corporate treasury strategy, is leveraging public debt and equity markets to increase the asset base. And that naturally leads or uses leverage. Leverage can be dangerous. Humans take things too far, that's going to be dangerous. But what I'd say is what the strategy is I think going to catch most people off guard. The one thing I would say that's different though is that, I talk a lot about these 50-year technological revolution cycles. And we're talking about the Bitcoin halving cycle. And so when it happens 2 times, it probably happens 3. And now it's happened 3. It's probably going to happen a 4th, right? So the more the cycle repeats, the stronger it gets. And if we look at this 50-year technological revolution cycle, I call them a quantum wave cycle, we're now on our 6th time it's repeated. And so That's a pretty reliable indicator. And it happens over 4 distinct phases over a 50-year period. And phase 1 is illustrated by this retail eruption. So we have this brand new technology. We're not really sure what it is. And there's a lot of noise. There's a lot of trial and error. There's a lot of disruption happening around this new technology. In 1908, which was 2 cycles ago, we had the birth of oil fuels, internal combustion engines, the automobile, and mass production. And within 3 years, there was 250 manufacturers, but the market couldn't support that. They all went out of business, and then there was 3. So you get this retail eruption. And I think, and then I'll tell you, phase 2 is then what's called the frenzy phase. Phase 2 is where we get the institutional, the corporate money starts moving in. Then we have the synergy phase where the technology really starts to be incorporated in everything that we have. And what happens is when you look at this 50-year cycle over these 4 phases, we can also overlay an S-curve onto that. So an S-curve is a way that we can measure technology adoption. And basically the way an S-curve works, and telephones and washing machines and color TVs, they all follow this pattern. And the way an S-curve works is the time it takes to go from 0 to 10% is the time it takes to go from 10 to 90%. So it's an S. The middle is parabolic.
Yeah.
Okay. So we overlay that onto this 50-year chart. And that's where we're at right now. We're in the second phase. It's starting to be the parabolic portion. And so without looking at understanding crypto and the layer 1 battles to the DeFi boom to the NFT boom, without even looking at that, we would have already known that the first decade, 12 years, was going to be an explosion of cryptocurrencies and a lot of trial and error of things. And we would have already known that the second 10 to 12 year period would have been dominated by institutional players. We already knew that. And that's exactly what we're seeing. I think a couple things are important to understand, though, is that in the altcoin boom, layer 1 and then through those, DeFi, NFT, et cetera, there was a lot of trial and error. That's what happens in that. We try a lot of different things. But what happens in phase 2 is, again, with institutional players coming in. So now what you have is real allocators, so public allocators, public companies. And we're also talking about big check sizes. So it's not the $1,000 checks or the $100,000 checks. Now it's tens of millions or billion-dollar checks. And a couple of things. Number one, as an institutional allocator, you have mandates of what you can and can't buy. Not to mention, most of the Wall Street players are playing not to lose, not really to win. And so I can't allocate $1 billion of capital into SUI. There's no liquidity there. Mm-hmm. I can't allocate $1 billion into whatever. Number one, there's an anonymous founder with a white paper. There's no auditing. There's no financials. There's no regulatory clarity. And there's no liquidity. So that starts to change the game a little bit, which is why, to your point, some of them have moved into these more treasury companies. Well, if we put it into a corporation, then we have those things, maybe, right? So I think that was number one. But let's just talk specifically sort of what's going on with Strategy and how other people can copy that. So what Strategy has done is they've used a public debt and equity vehicle, the company, MSTR, to acquire Bitcoin. At this point, they've got over 600,000 Bitcoin. But what's the purpose of that? You sort of asked earlier, is it just to acquire Bitcoin? Yes and no. So I would break down these treasury strategy companies into 3 main buckets. So bucket number 1 is I have a company, we have savings, we have a treasury, and we allocate some to Bitcoin. Mm-hmm. And I would put Tesla into that bucket. Right. So Tesla has money, Tesla's got billions of dollars of Bitcoin, and it just sits there. So that's layer number 1. Layer number 2 is I have a business and I have a Bitcoin treasury strategy company. Semler Scientific would be a really good example of that. So Semler Scientific is super committed to their Bitcoin treasury company and trying to leverage the public debt and equity markets to get more Bitcoin, and they have a lot of it. But they're also running a medical business as well. So we have the medical business and we're leveraging this, and a lot of the new treasury companies, Bitcoin treasury companies that have popped up, maybe like, David Bailey's Nakamoto or Swan's Saquon's, they're looking at being maybe like a conglomerate where they have all these different businesses and they have a Bitcoin treasury strategy company. So that's number 2. And then there's the layer 3, which is what Saylor's doing with Strategy, which is a pure play Bitcoin treasury company.
Mhm.
And the difference of that is that not that we're not going to run any real businesses and we're just going to buy Bitcoin. That's not what it is. What it is that we are building Bitcoin-backed financial products. And this is what almost nobody's gathering. So in the world today, we have about $1 quadrillion, $1,000 trillion of parked in what we call store of value assets. In bonds and equities alone, there's about $700 trillion. Most of the world is not like you and I, or people even listen to this. Most of the world just has their paycheck, going into some mutual fund, 401k every 2 weeks, and some plan, some pension allocator is doing a 60-40 bond split and they're buying different instruments. That's most of the world. 97% of institutional capital, those hundreds of trillions of dollars, cannot buy commodities by mandate. They're just not allowed to. They can't buy gold, they can't buy wheat, they can't buy copper, and they can't buy Bitcoin. So what are they buying? Well, they're buying credit instruments, and they're buying like equity instruments. So what do I mean by credit instruments? It's the fixed income market. The fixed income market is the largest market in the world. So if anybody's watched The Big Short, which was documented the real estate housing crash, you take these debt instruments, I have all these mortgage loans, all these auto loans or whatever, and then you package them up. You create a CDO, a collateralized debt obligation, and then you securitize it, and people buy into it. The problem with that, as we saw with The Big Short, is that I don't really know what I'm buying. I'm not even sure what's in that package. I don't know what the ratings are of those things. So there's a lot of risk, number one. Number two, the returns are really low. They're paying me 3 to 5%. So I'm getting 3 to 5% on some unquantifiable risk that I have. And then to make it even worse, those are under leveraged. So meaning or under collateralized. So maybe I'm getting I'm 3 to 1 or something like that, right? So there's not enough collateral to even cover the debt we have against them. So that's the majority of the world today. I mean, obviously there's treasuries as well. Over the last 5 years, the U.S. Treasury, as measured by the TLT, which is like the long end of the curve, the long bond, the U.S. Treasury, which is the bedrock of the global financial system, on a Sharpe ratio, which is how we measure risk-adjusted returns, is more risky than Bitcoin over the last 5 years. And so that's what the majority of the world is buying. Or they're buying equities in companies that aren't returning profits. So what Strategy is doing is they're taking the 600,000 Bitcoin that they have, and they're creating Bitcoin-backed credit and equity instruments. So now they're selling equities, STRK, STRF, STRD, and the newest one, STRC. And it's creating a way for all of that institutional money, trillions of dollars, to now get access to Bitcoin through one of these types of instruments. And the market is obviously enormous. We're talking $600 trillion into a $2 trillion asset. That's the real game that's being played here.
And do you see potentially this unwinding, because there's a lot of debt involved, right? And you've got to pay this debt back, and this is one of the things that people are often talking about, that we might see a huge market collapse because of all these treasury companies unwinding.
Yeah. So let's talk about that for a second. So I think a lot of people are misunderstanding what's going on. Even people that are running treasury companies maybe are misunderstanding, because Michael Saylor maybe sort of head faked the industry. So there was MicroStrategy, and with MicroStrategy, he took on a lot of debt. He raised billions of dollars at like 0.8% interest, which is like amazing. He took on all this debt to buy Bitcoin. And a lot of the market was like, but what if he can't pay the debt? And how will he afford the interest on the debt? And all these different questions have come around it. And basically that's what you're asking right now.
Right.
But he changed the name of the company to Strategy. And now there's a 2.0 strategy. Strategy now, the 2.0 version, doesn't use debt. He's selling equities that are covered by the Bitcoin as collateral. Now, I said even people that are running Bitcoin treasury companies aren't really understanding what's going on. So a lot of these companies are they're raising 100 million of equity and 100 million of debt, or 200 million equity and 200 million debt. thinking still sort of in that framework. The company that we just launched now, Satsuma, which is in the UK, we've only raised equity and we're not taking on debt. We don't need the debt. So then you've sort of eliminated that risk. But let's talk about the risk for a minute, just so we can understand how big of a problem this could be.
Yeah. On the Saylor example, you said that they're selling equity collateralized by the debt, or by the assets, right? By Bitcoin. But I guess the question is then, what happens if Bitcoin goes into another 80% correction, and now there's not enough collateral to back the equity that was sold?
But there's no mechanism to sell the Bitcoin.
No, they won't. No, but what if the market just sells off? What if we have another 80% correction in Bitcoin, and all of a sudden the value that's collateralized backing these debt instruments?
Yeah, it's a great question. So the instruments, the strike, they're being sold as a coverage ratio. So what's backing them is the credit worthiness of MicroStrategy, the credit worthiness of the company. They don't have a collateral ratio. Mm-hmm. So it's a difference of coverage versus collateral. So collateral means they're secured against the asset. So there could be some mechanism that would force you to sell to increase the margin of that collateral. But that's not how these are sold. These are being sold with a coverage ratio that's backed by the credit worthiness of MicroStrategy. So there is no mechanism that would force them to sell that.
Okay.
It's unsecured.
Yeah.
If that makes sense.
Makes sense.
So that can't happen. Now, let's just talk about, there is some debt in the system. And so certainly some companies, I haven't seen it yet, but they certainly will. Some companies will take on tens of millions or hundreds of millions of debt that might be due in 1 year. It might be due in 2 years, which could be at the worst time.
Yeah.
Maybe Bitcoin's down and now they have to pay the debt and they can't afford it and they're going to be forced to sell the Bitcoin. And that's what everybody's afraid of. We don't really see that yet. So I don't see that being a big problem, but it could be. But let's think about this for a minute. If we look at, you can go to bitcointreasuries.net and you can see all the public companies and how much Bitcoin they hold. If you take all the Bitcoin they hold, let's take MicroStrategy out of it because they're not going to be forced to sell the debt. And you take all those Bitcoin treasury companies and you liquidate all that Bitcoin today, you're talking about a few $1 billion. Just a week ago, we saw Grayscale dump $9 billion of Bitcoin in a single day in a market order. A single day in a market order, for everybody that doesn't know what that means I just dumped it into the market. I didn't try to time it. I just said, screw it, I'll take the slippage, right? And the market just absorbed it.
Yeah.
9 billion in a day. So if we liquidated all the treasury companies today, it's like a fraction of that. And of course, it wouldn't even happen all at the same day. So I think that currently, the amount of risk that we have in the system is minimal. Very, very minimal. Could it be more? It could. And we'll see when we get there. Hopefully, we'll see more companies do what we're doing at Satsuma, which is taking equity and not debt. And then there's no forced sell function there.
Okay, so for folks watching this who might want exposure to these treasury companies, Bitcoin treasury companies, what should they be looking for when evaluating an opportunity?
Yeah. So first of all, I would just say that these aren't really for Bitcoiners or crypto people. They're really for TradFi people. Right? So really what Saylor's doing with strategy is he's creating these products that are replacements for other stocks or other credit instruments, right? So rather than buying this opaque basket of debt obligations with higher risk for 5%, I can buy a pristine basket or a pristine asset backed by pristine collateral of Bitcoin that's a 6 times over coverage and it pays 10%. Right? So it's not like, should I buy Bitcoin or this? It's like, should I buy this risky 3% or this safe 10%, right? But what I'd say for Bitcoiners or crypto people that are sort of looking at this, currently right now, and this is going to change, but I'll give you the current picture and then I'll give you the new picture. The current picture right now is they're looking at these with new sets of metrics. So for the main metric we're looking at is MNAV. So that's the net asset valuation. What is the asset base? And what is the multiple that I'm paying on top of that? So strategy is around a 2 times right now. 2 times its asset base. Metaplanet is in the 4 or 5% range, and these go up and down.
4 or 5.
4 to 5 times.
Yeah.
MNAV. There's some smaller ones that have been as high as like 10 times MNAV, right? Why would some be at 10 times when strategy is at a 2 times? Well, a lot of that has to do with what's called Bitcoin yield, or the rate, the percentage change in the Bitcoin that they hold. So if I went from 1 Bitcoin to 2 Bitcoin, that's 100% Bitcoin yield. And I think people put way too much into that metric, because if I went from 1 to 2, it's 100% yield, but that's only 2 Bitcoin. Whereas MicroStrategy or strategy, now that you have 600,000 Bitcoin, you can add, they just added 21,000 in a single day just a few days ago. 21,000 in a single day, which is more than any other company holds, but the Bitcoin yield is very small. But the reason why a lot of investors would justify this is the MNAV is high, 6 times, let's call it, or 5 times. Well, what's the rate that they're adding to the Bitcoin? And more importantly, how many days or months would it take to cover the premium I'm paying? So we have another metric called days to cover. So how long? So at the current rate, it is going to take 600 days, but this company, the current rate is 30 days. So even though I'm paying a higher premium, at the rate they're acquiring Bitcoin, in 30 days, we'll be there. And that's sort of like more of like a TradFi metric, which is like a price to earnings ratio. So like based off of their current earnings, how many days or how long will it take me to get there? So those are sort of the main metrics. So like number one, what am I paying? The multiple, that's the premium that I'm paying. 2, what's the rate of Bitcoin growth, Bitcoin yield? And then number 3, like I said, that days to cover that. Now, that's how Bitcoiners are looking at it. But the real opportunity is what I call the escape velocity, is when Bitcoiners stop looking at it and TradFi looks at it. You see, something big happened this year that most people aren't even aware of. And that is that accounting rules, GAAP, changed the FSAB rule, which says that now you can take the asset base and the gain and call it income. And a lot of people haven't really caught on to this because it sort of just happened. And based off the amount of Bitcoin that strategy holds, they posted about a $14 billion gain in the last quarter, which puts them into some of the top companies in size of that. And when you look at like high growth companies in the Mag 7, for example, none of them trade on a book value. It's not how you value Tesla. You don't value it on a book value. You value it on a PE ratio, a forward-looking price. So Tesla is about an 80 times PE ratio. So that means at its current earnings, it's going to take 80 years to get to that valuation. Most of the Mag 7's in like a 30 to 40 range, 30 to 50 range. And so based off of the new accounting rule change that just happened, that most people haven't caught on to, I believe strategy should be valued more like a high growth company, like a Mag 7 company. And instead of trading at a multiple of its book value, because none of those are, it should be trading off of a discount to its future valuation. So then we go, okay, well, what's the future valuation? Well, they have over 600,000 Bitcoin now. I would imagine by 2030, they're going to have at least 700,000, probably 1 million.
Yeah.
But let's say they have 700,000. I think Bitcoin's $1 million by 2030. That means they have 7 trillion of book value. So even at their current multiple of 2, which doesn't make any sense, that's 14 trillion.
Yeah.
The most valuable company in the world right now is only 3.5. We're talking 14 trillion. But I think that's going to be even different. So I think that they will be trading a multiple to their future valuation. And let's call it not 30 to 50 like the normal Mag 7 gets, call it 20 or 25.
Right.
We're talking hundreds of trillions of dollars of valuation, which sounds incredible. And like, how could that ever even be? It doesn't make any sense. But that's where this is going. And I think the market is completely missing that. Because we have a new financial asset, it's the first new financial asset we've had in 500 years. And we have a new piece of technology that allows us to build things that we've never imagined because we didn't have the things that took to build the things. And so Bitcoin is this new financial asset that allows us to build these new types of companies and new types of financial products and a new financial system that we never imagined. And if we have to sort of break things down to more of like a first principles level to sort of see what's really going on. And if you think about a business, if I'm Apple, I sell a product like an iPhone, and I have to look at like, well, how big is the market for that iPhone, and how much more do I think I can grow the market, and what's going to be my profit margin on that product, right? So I think Apple posted like $94 billion of income last quarter and like $24 billion of profit, something like that, like really good. You have BlackRock is also a company, and they sell a product. They sell financial products. So they could sell like a $50 million slug of its, Bybit or whatever. And how much do they make on that? What's their profit margin? I believe it's about 0.25% per year they make for that. Well, now Strategy has a product that they sell, and it's called Strike or Strife or Stride. And they sell that into the market now. What's their profit margin? They sell a $50 million slug, they have a 50% profit margin. So they're selling products just like BlackRock or Apple, but their profit margin is bigger. So what Michael Saylor calls the durable business model. So now take that into consideration with the future growth and the adjusted GAAP metrics, and the valuations are higher than any of us can even conceive of.
Does it not seem like the way that we normally think about valuing a business and traditional state of mind is that like you must be doing something, generating revenue and providing value, and people are willing to pay you for that value, and so that value becomes revenue minus your cost of goods, and now you've got profit, and like that's a clear way to value a business. But it seems in a way that Michael Saylor is just creating new financial engineering mechanisms to just acquire more Bitcoin and sell things that there's no real business model there other than just acquiring Bitcoin, from what I can tell. And so it's all based on the fact that number go up, which we believe it will,
Yeah.
but
No. So let's break that down again to like first principles. So what you said, it seems like a business is selling a product, right? And there's
service, yeah.
a service or a product, and there's revenue, right? And then after the cost of goods sold, there's profit, right? And that's creating the value. I think that's what you said.
Yeah.
Right. So Strategy is selling a product or a service, and there's a profit after the cost of goods sold. No different.
What is the product or service they're selling?
Yeah. So the product or service that they're selling is there's hundreds of trillions of dollars, about $600 trillion, trapped behind regulatory moats and mandates. They can't get into Bitcoin. So they're stuck buying credit instruments that are risky and under collateralized and paying below inflation rates.
Okay.
Or equity instruments, right? And so we have hundreds of millions of people, hundreds of trillions of dollars that are a sinking ship. They're a melting ice cube and they're losing. And those people desperately need Bitcoin in a really, really bad way, but they can't get it.
So essentially he's giving them an opportunity to come in to the Bitcoin game at a premium, essentially.
It's what I would say, I mean, just to make it simple, it's not, yes, it's financial engineering. It's selling financial products. So it's, what does BlackRock offer to the market? Do they sell a product? BlackRock?
Well, they invest in things, right?
Well, no, they create vehicles
right.
that people can invest into.
Yeah.
Right. So they're creating financial products, and those financial products are so all these people can now invest into those and hopefully have their savings buy them more goods and services in the future.
Mm-hmm.
Right. As I kind of started out by saying, the majority of the world just passively invest part of their paycheck into these things. Maybe there's some future. I do believe there's a future where Wall Street is greatly diminished and shrunk, and most people just use Bitcoin and they can just beat all of that. But not today. Today, there's hundreds of trillions of dollars that needs to be saved. They need a way to get into it. The problem is that it's not just one big pool. What we have is all these different countries. And with all these different countries, we have all these individual pools. So for example, in the UK, we have a $2.7 trillion pool that can only invest into high risk credit. And we have a $3.6 trillion pool that can only invest into rated securities. And we have a $1.4 trillion pool that can only, and each one of these pools has their own investing mandates and rules. And it's stuck. And so what Saylor's doing, and what these other companies are doing, is creating individual products that are custom built to fit within each one of those mandates.
Got it.
That's why he didn't just release one product and then a second product and the third one, and each one, now there's 4 products. Each one works with a different pool of capital to fit within it. Well, that's great for the United States. Now Metaplanet's doing it in Japan.
Yeah.
And that's Sumo could do it in the UK. And so that to me seems like a very valuable service that people really need, desperately need.
So is that kind of what you guys are going to be doing in the UK?
That's exactly what we're doing in the UK.
So you're building these different financial products.
So we've mapped out what we see are the biggest pools of capital. Then we break down, this is my role, so we've identified the biggest pools of capital. We understand each one's individual specific investing mandates. And then we create products built to fit within each one of those mandates that gives those people that are stuck in those trapped pools of capital better options to get safer, higher returns.
Cool.
Yeah.
Cool.
So I would argue that if we break it down to first principles, that is a product.
Yeah.
It was created. It takes labor and attention and energy to sell that product. There is a cost of cost of goods on that.
Yeah.
And I believe it's a highly valuable benefit to the people. Also, it produces value. Now, none of us want money. Nobody in the world wants money. We want goods and services. So money is a means, it's a way for us to get the goods and services. So at the end of the day, is it as valuable as building a house that somebody could use or a car that I need to drive around in? I mean, no, they're different, but it is a value. It is a valuable service.
No, it makes sense when you explain the lock capital and giving them tools specifically. And this is all working around. This is all because of bureaucracy, essentially, right? It creates an opportunity for.
Well, it's due to a lot of things. I mean,
if you're sitting on a bunch of cash and you can't put it in certain things like buying Bitcoin spot, then this is the only reason this opportunity exists, right?
Well, the opportunity exists, number one, is because governments keep printing money.
Yeah.
So if the governments didn't debase our currency, we wouldn't need to invest in the first place. So it starts there. So now, because they debase the currency so fast, everybody has to go out and invest their money. So that's the solution to that. Now, how do we invest our money? Unfortunately, as you know, the majority of people just want to go through life passively. They don't want to think about this. They don't want to pay attention to it. It boggles my mind that most people have spent 12 years going through primary school and maybe 4 or 5 years of secondary school. They've worked hard to try to get raises and all these things, but they don't want to spend any time thinking about their money after they make it. But that's the world that we live in. So inflation forces us to invest. Most of us don't want to be an investor, so we give it to somebody else. And now, yes, due to regulations and whatnot, each one of those funds has these regulatory moats that it's stuck into. And I would like to say, dude, just cash out your 401k, pay the friggin' penalty, and buy Bitcoin.
For sure,
it's going to make it up in the long run, right? Yeah. And I want to tell that to as many people as possible, but the billions of people in the world aren't just going to wake up and do that tomorrow.
How big do you see the Bitcoin treasury space getting?
Yeah. Well, I believe that every single company in the world will be a Bitcoin company at some point. Yeah. When I started my first e-commerce business, I was the only .com in the action sports niche, and it was still mail order in the magazines at the time. And so there was really something about being a .com. I'm an internet company, but there's no such thing as internet companies anymore. Every company is an internet company. Right. And so right now there's a Bitcoin company, but eventually every company will be a Bitcoin company. Yeah. So I think there will be unlimited. Now, specifically more in these financial terms, like these financial product companies, what I would say to that is that, Strategy is making multiple of these products. Metaplanet's making different products. Satsuma will make different products. So there'll be a lot of different financial products. How many financial products can there be? In the US, there's 3,900 ETFs. Just ETFs. There's over 10,000 equities. So, that's 14,000. Then there's bonds, there's corporate bonds, there's municipal bonds. So we have tens and tens of thousands of different types of financial products just in the US alone. So how many of these could there be? I guess tens of thousands.
Yeah, that's a lot of demand for spot Bitcoin. So I guess it comes back again to, could this be, despite the 4-year global macro cycle and liquidity cycle, that capital that's still locked, that needs to find these specific instruments he talked about, needs to find a home.
Yeah.
And the options right now are like this shitty instrument over here, or like these nice new pristine instruments that you've talked about.
Yeah.
So when they become available, they probably want to park capital there. That means more demand for spot Bitcoin.
Yeah.
I mean, could we see a scenario where the Bitcoin defies the 4-year global macro cycle, where even if global M2 comes down, Bitcoin still keeps going up?
I think so. And there's a couple ways that I think about this. So, we need to look at it from a bunch of different angles to sort of get an idea of this. And I've talked about this 50-year cycle and the 4 different phases. And if we overlay like an S-curve onto that. And so I believe we're going into the parabolic part of the S-curve. Mm-hmm. And so in that parabolic part of the curve, we could potentially see Bitcoin be way more asymmetric to the upside and have more of a muted to the downside,
Right.
because we're in the parabolic growth part. So we already talked about the change in the makeup of buyers from retail moving into the cold storage of either sovereigns or these treasury type companies, number one, so that we've changed that. So we have more buying and less selling, so more parabolic to the upside, which happens to overlay with the S curve. I think another thing that I think about is when you look how things are traditionally done with companies, you think of the law of large numbers and the diminishing returns. And so Bitcoin, has had an amazing growth trajectory over the last 15 years. But over time, it's gotten slower. So like over the last 5 years, it's gone up by about 85% compounded annual growth rate, the CAGR. The last 3 years, it's about 65%. And a lot of people expect that to continue to dwindle down. I think Saylor says he thinks it averages around 21% over the next 20 or 30 years, something like that. And so we just sort of expect it to continue to trend down. I do think there's a possibility that we might see CAGR actually start to accelerate a bit for a while. And the reason why I would say that is because traditionally what we see with financial assets is VC money funds it, institutional money comes in pre-IPO, it gets listed, and then it gets to the public who writes the small checks. So you get the big checks first, the big explosion, and then it's continued with little checks of retail, so it grows much slower. But Bitcoin is the exact opposite of that. Bitcoin started small, with small checks funding it. Now we're getting to the big check size. And so it's completely upside down. And so maybe it grew slower with the small checks. And even though it's a bigger number today, we're getting bigger checks. And we could potentially see CAGR start to move back up again, or at least maybe hold, pretty solid. So I think between the change in the makeup of the buyers, the parabolic part of the S curve, the way that the big checks versus the small checks have come into the ecosystem, there's a real possibility of that.
Do you have any? Do you ever do any price targets, or any idea what you think it would be in, say, by end of the year?
I have a lot of price targets.
What do you think?
Yeah. Here's what I would say just real quickly. So I'm going to give you price targets out to 2050, maybe into 2060. But I typically think in 5-year terms. Saylor talks about 10-year timeframes, because most businesses, so I told you I'm a venture capital investor in the Bitcoin space. A typical venture fund is about a 10-year lockup, right? And the reason why it's a 10-year lockup is because when I'm funding something like Uber or Airbnb in an angel round, it takes about 10 years to get liquidity. So people that build real companies, real investors, they think in timeframes, 10 years. I'm going to put money in, you put money into Kraken how long ago? 6-7 years ago? And it's still there, right? So Saylor talks about these 10-year timeframes. Venture capital investors think in 10-year timeframes. I typically think in 5-year timeframes, because I started my career in real estate, and from the time I'd find a piece of dirt to develop it and sell it was about 5 years. So I'm a little bit less. I don't really think in where it will be in 6 months from now. I'm happy to play this game, and we'll throw out a couple numbers. I think anybody trying to look at their portfolio on a monthly or quarterly basis will never make it.
100%.
Charlie Munger said that the big money's not made in the buying and the selling, the big money's made in the waiting. So I need to wait, number one, for the opportunity to develop, and number two, for it to grow. That's where the big money's made. Warren Buffett, his partner, said that if new investors came into the world knowing they only had 20 moves their entire career, 10 buys and 10 sells, they would outperform everybody. So I think if you're looking at your portfolio on a monthly basis, you're going to drive yourself crazy, and you're never going to succeed. So let's start with the bigger picture, and then we'll answer the shorter term picture. So I have a whole video breaking this down. I'll send it to you. You can link to it down below. And I have all the math. And so I will give you the high level math, but if they want the detailed math, they can get into this. So when global liquidity goes up, asset prices go up. Okay, so as the government continues to expand the debt-based monetary system, money goes up, asset prices go up. The government, the U.S. government's Congressional Budget Office, the CBO, projects out the next 30 years to 2054. So they tell us what they expect the deficit spending to be, the debt levels to be, the annual spending budget to be. They give us that. Now, in my opinion, they're going to be way off, because they always spend more and increase the debt faster than they expect, but they give us the next 30 years. So I'm using this as an example. The first thing, if we go backwards in time a little bit, just so people can get an understanding, we have what's called store of value assets. And so we make money and we buy things, but eventually creators create more than they consume and they save it. And they're typically going to save it in store of value assets, which would be equities or bonds, maybe cash, gold, collectibles, art, things like that. Okay, that basket in 2010 was about $364 trillion. Today, that basket is about $1,000 trillion or 1 quadrillion. So from 364 to 1,000. So it's about tripled.
Yeah.
Okay, in 14 years. And that's based off of the rate of the monetary expansion. So the S&P 500, the median US real estate is pretty much a perfect proxy for the rate of monetary expansion. So we understand that. And then what we do is we take the CBO's numbers and project out, okay, if the debt continues to grow at that rate, what does that mean for this basket of goods? I believe that pushes this basket, this store of value assets, to 1.6 quadrillion by the end of the decade, by 2030, 3.6 quadrillion by 2040, and I think it's 8.5 or 8.6 by 2050, because they project out to 2054. Now, again, I think that's conservative because they're going to print and spend more. Okay, so that's how big the basket is growing. Now, Bitcoin is a store of value asset that's in there.
Yeah.
So the next question we have to ask ourselves, and this is an assumption, is what percentage of that basket do we think it can get? So when I'm investing as a venture capital fund into Uber, well, taxis are this big, limos are this big, van shares is this big. So collectively it's this big. If I can get 5% of that market, I'll be worth this, right? So we know that Uber and Airbnb both captured 10% of their market in less than 10 years. It doesn't mean hotels are gone. There's still hotels, but we have Airbnb. Doesn't mean taxis are gone, right? And so what's happening is Bitcoin is growing faster to take a little bit of the market share from real estate and from bonds and from equities. So the question we ask ourselves is, what percentage of that basket do we think we can get? Well, if Bitcoin can capture 1.25% of the store of value assets by 2030, that'd put it at $21 trillion or $1 million per Bitcoin. Now, we can check that math in a couple ways. Number one, we can look at the compounded annual growth rate, the CAGR, and how it's been sloping down. So I told you it's 85, now 65. That would finish the decade at a 50% CAGR. And we're already above that, so like it'd have to drop pretty low to end up at about, so that's at a 50% CAGR, we'd end up at $1 million, 1.25% of the basket. So $1 million by 2030 is my target. We've seen Arthur Hayes say I think he said $1 million by 2027. Kathy Woods says 1.5 by 2030. We'll see. Okay, now let's go out to 2040. If Bitcoin could get to, again, following CAGR, continuing to diminish down, let's say it drops down to 30% for the next decade, following the growth basket, if it can get to 8% of the store value assets, it puts it at $14 million per Bitcoin. And by 2050, if we continue the downward sloping of the CAGR, maybe it gets down to 20% at that point. And I just gave you reasons why it could even accelerate, but let's just continue, it goes down. And by now, I believe the Bitcoin can get to 20% of the basket. That puts it at $45 million per Bitcoin. So that's the high level math on how we get there, and those are my price targets. Now, going back to the question of where are we at, I think you said by the end of the year, by the end of the cycle.
I mean, that's more interesting, to be honest. I think everyone's just throwing darts in the dark, unless you have those are pretty well thought out, rational, logical reasons to get you to those conclusions.
The only rational thought, I like to try and think of data to get to these numbers. The only rational thought we have is we can look at some of these on-chain data indicators like I've given you before, right? So if we look at, MVRV, or we look at, the Pi cycle top, we look at some of these types of indicators, it gives us like a range of where we think, because they're moving averages, we're not sure where it's going to converge. It looks like it's in the 150 to 250 range, so it's looking like the median of that is, maybe a 190 to 200 range based off of that data. There's a whole bunch of stuff. I mean, if Trump gets Powell out sooner and drops rates to 1.5% in the next 30 days, so there's a lot of things that could happen. But I would just say, based off of what we can see in the on-chain data, it's probably going to be somewhere, I'm sort of thinking in the 150 to 250 range, maybe 200 is sort of the median of that.
Maybe the biggest wild card is sovereigns buying Bitcoin, right? We have the strategic reserve implemented, but we haven't started acquiring anything yet. I think we will. Bo Hines keeps saying that they're going to and everything like that, but we haven't seen it yet. What do you think happens when? And do you think it's a when, not if, the U.S. starts buying Bitcoin? And then if they do, what do you think happens?
Yeah, the U.S. buying Bitcoin is really interesting. I would say it's my base case. I think it's the most probable scenario that the U.S. will be buying Bitcoin. Mm-hmm. Yes, I think that's going to happen relatively soon. And they will probably be buying more than most people expect. There's a couple of reasons why I feel really strongly about that. Number one, 2, and 3 is that the Trump administration is buying Bitcoin.
Yeah.
And when I say the Trump administration, Howard Lutnick, who's the Secretary of Commerce, who's Trump's old buddy for 30 years from Wall Street, who Trump brought on to run it. Before Trump won and before he became part of the Trump administration, Howard Lutnick is a OG Wall Streeter, owns a company called Cantor Fitzgerald, deep in Wall Street. And previous to this, it was a year ago at the Bitcoin conference, he came and announced that Cantor Fitzgerald would open up a $2 billion Bitcoin credit line for institutional players. That was big. Back then, $2 billion in the Bitcoin space was still a lot of money. I mean, it still is. But then Cantor Fitzgerald, again, connecting in Wall Street, moving into the Trump administration, takes a majority position in MicroStrategy and Tether, the stablecoin. Yeah. Making moves. It's interesting. Then joins the Trump administration, and now the Trump administration not only has the strategic Bitcoin reserve, but also potentially setting up a sovereign wealth fund.
Yeah, right.
Which will probably both have Bitcoin. Then we have the new stablecoin bill, which, did he just buy part of the largest stablecoin company? Oh yeah, that's interesting. Scott Bessent, head of the Treasury, says he expects stablecoins to grow to $3.7 trillion by 2030. And Trump himself, or not himself, but his company, Trump Media, that he owns controlling interest of, just bought $2 billion of Bitcoin. So basically Trump himself bought $2 billion worth last week. And Howard Lutnick has sort of been removed from Cantor Fitzgerald because he's working with the Trump administration, but his son now is running the torch and has now invested into multiple Bitcoin treasury companies to the tune of multi-billion dollars. Now, also Trump has sort of this history of maybe telling the market or front running the market on what's going to happen. So when we had the tariff scare and things had, we had the big crash in the markets, he put out an X post or a tweet or whatever it is now these days, and he said, I forget, something about like, hey, now might be a good time to buy, or said something like that. And then what happened? Oh, tariff deals were paused and the markets went on this extreme rally. And so, based off the fact of billions of dollars being purchased by the Trump administration, the stablecoins, all of that, I think they're telling us that Bitcoin is going to go much higher. Some of the things that they could control of that would be buying it for the strategic reserve or the sovereign wealth fund. And so that's why I feel pretty strongly, I'm guessing that's going to happen. And what happens when that happens is that the U.S. is the most influential country in the world. And if the U.S. does it, every other country is going to have to do it as well.
What would you do with your personal Bitcoin? Are you really just watching these goalposts? And so, despite everything, rates got lower, but Pi cycle talk could be wrong.
Yeah.
Right. And how do you feel about selling the precious Bitcoin because you're trying to time the market, and all of a sudden that signal gets invalidated because there's just too much tailwinds?
Yeah.
And all of a sudden you sold at 200 because you thought 200 was a top, and Pi cycle told you. And you just sold your stash because you thought you crushed it this time and nailed it perfectly.
Yeah.
And then Bitcoin goes from 200 to 300 the next day, and then the next day it goes from 300 to 400 the next day.
Yeah.
You're still sidelined.
Yeah.
Does that worry you?
Heck yeah.
It worries me.
Heck yeah, you should. Heck yeah, you should be worried. Everybody should be worried by that. And the reason why is because you will certainly lose.
Mm-hmm.
You won't win. Nobody will. There might be one or two lucky people. For the most part, you're not going to win. And the reason why is some of the reasons you've given us. If you back test this and you put yourself back to 2017, when Bitcoin started at $1,000 in the year and ran up to $4,000, every indicator was telling you to sell at that point.
Mm-hmm.
Every indicator. And if you would have smashed it. I mean, you just made 400% on your money. That's way better than you could have ever done in any other market. You crushed it. Good job. Congratulations. But then Bitcoin went to 20,000. And then it pulled back to 6. So now you bought in higher.
Yeah.
And if you're a trader, if you're trying to get more fiat, if you're a fiat maxi, as I like to call it, if you're a fiat maxi, whatever. You bought from 1 to 4, you made the money. You bought back in at 6, you sold at 18, you made more money.
Yeah.
You bought back in at 35 to 65, you made money. I have a friend, I'm not going to drop his name, but he runs a really big fund, hundreds of millions of dollars. And he likes to trade Bitcoin. He thinks it's one of the best trading things, and he jumps in from here to here and crushes it and jumps in from here to here. And if that's what you're trying to do, if you're a fiat maxi, then you could mess with that. But for me, I'm trying to get as much Bitcoin as I can.
Right.
And so for me, if I were to sell at 4 and buy back in at 6, I lost Bitcoin, right? And so what I do, and what I think the proper way to do this is, and I'll give you 2 reasons why, but what I do is I use this data to think about my buying, but not my selling.
Yeah.
So what I do is, as of right now, Bitcoin is about midway through the cycle. When we look at all these indicators, it's not expensive or overbought. It's right sort of in the middle. So as of right now, I am still fully allocating to Bitcoin, meaning pretty much all my money is going into Bitcoin at this point. Once it starts getting to the top, again, these are moving averages, but once I see that I'm at the 8th sign or the 9th sign, I'll certainly slow down my buys, if not pause my buys altogether.
Makes
right?
sense, yeah.
And then when it looks like it's starting to get cheaper again, then I'll resume my buys or take a bunch of that money that I had been holding and dump it in at a fast rate. Mm-hmm. So that's sort of the way that I think about it. I could slow my buys down or pause my buys temporarily and then lump it back in to catch back up again. But certainly I would never sell. And the other reason why I would never sell, besides you're going to be wrong, you'll get out too early. The other thing, even when the problem with timing the buys is, I don't know the exact data, so this is paraphrased, you can look it up, but something like, the S&P 500 is averaged like 8% over the last 30 years. And if you miss the best 10 days, your returns get cut in half. And if you miss the best 20 days out of 30 years, you got no returns, right? And Bitcoin's even more explosive than that. So what happens is we have these really big moves, and they happen in one day. So while you're waiting, you get the big move, and now you get in the next day, but you've missed the majority of that gain. And so it makes it even harder. That's why nobody will succeed in this game doing it. So I don't advise it. There's no track record that you can see that works. There's no back testing that you can see that works. If you look at a chart, it's like, oh yeah, I can have that.
Easy, yeah.
But if you look at the actual indicators, that would tell you there's not.
Yeah.
But the other reason why we don't want to sell is because of wealth strategies. I think maybe before we started recording, I was telling you about how I coach some people with using wealth strategies. So the wealth strategies are that you never sell assets. And if you look at the most wealthy people in the world, if you look at Jeff Bezos or Elon Musk, Jeff Bezos got to be one of the richest guys in the world because he owns Amazon stock. Mm-hmm. He didn't trade Amazon stock. And Elon Musk owns Tesla. He doesn't trade Tesla.
Right.
Michael Saylor owns strategy. He's not going, well, Metaplanet's going up faster, I'll sell my strategy to go buy Metaplanet, right? And so what happens is the wealthy buy assets and they never sell them. And there's a relationship difference. Poor and middle class mindsets work to earn money to pay their bills. And so the relationship they have is very transactional in nature. And they think about making enough money to pay their bills, and they think about credit as something to help them expand their lifestyle. So they get the bigger house, the bigger car, the faster car, go on vacations. But the wealthy do it different, right? So what they do is they buy assets, they work to buy assets. And then they use the assets to pay for their life, right? And what I'm saying is they use the assets to pay for their life, not by selling the assets. They work to earn money to buy the assets. The assets pay for their life by using debt. And so the wealthy use debt not because they don't have the money, they're wealthy. They use debt because it's cheaper to use someone else's money than their own.
Right.
And so Bitcoin gives all of us the opportunity to do that. I have a book, it's called How to Retire Tax-Free Off of Bitcoin. And basically, what we can do is if we rethink what we consider cash flow. So I told you my story. I sold my businesses to buy passive income in real estate, which is not passive, right? So we think about like, I need to buy a dividend stock, or I need to stake my Bitcoin, right? Or I need to buy real estate or treasuries. I need to buy something that gives me cash flow, right? Warren Buffett doesn't like gold or Bitcoin because there's no cash flow. So let me stake my Bitcoin and make 6 or 7% yield. But I think if we rethink cash flow, so if I bought a house for 1 million and 2 years later sold it for 3 million, would you consider that cash flow?
Yeah.
Yeah, I made $2 million in a year, right? Yeah, of course. I don't need to buy the house and rent it for cash flow. I could just buy it and sell it for more. I mean, that's cash flow too, just over a different time period, right? So Bitcoin is going up, as we've said, 65% a year. Maybe it slows down to 50% a year. So going up 50% a year. That's appreciation. What I can do, what the rich do, and what we can all do now, is I can harvest the appreciation using debt, right? So if I borrow, most of us, I have a calculator. If you get the book, you can get the calculator. It's all free on my website. But you could borrow about 10 to 15% loan to value against your stack every year, basically forever. Harvest the appreciation using debt. That's pretty passive. I mean, sure, each year I have to kind of renew the loan, roll it over, make the payments, whatever. But I could just do that. So that's why we don't want to sell the market. If I sell the market, I got to pay tax.
Yeah.
Now I got to pay the tax. I'm probably going to miss out on gain. I'm going to buy back in too late. And half my wealth that I just made goes to Uncle Sam or whatever country you're in. But if I never sell the asset, I get the full appreciation. I can buy back in a little bit lower. And then I just leverage it with debt. So it's all tax-free income because the debt is not taxable. So that's the strategy that I recommend. I call it a 5-year retirement plan. As I already kind of said, I think Bitcoin goes up a 10x in 5 years. So if you had $100,000 in Bitcoin today, in 5 years, that'd be $1 million. That'd be good enough for 100 to 150 grand a year, tax-free for the rest of your life. And most people can get there.
Awesome. Cool. Thanks, Mark.
Yeah.
Yeah.
Cool. All right.